Hi. The budget week and the post-budget week is gone, and now we're all wondering whether the bull market will continue, or is the bull in the Indian market going to pause for breath because he's looking tired, he's looking fatigued, and he's looking labored. For sure, the markets gained on a week-on-week basis, but the rallies were definitely smaller. And the bank Nifty could not even take out the previous Friday's high, which is the 5th of February 2021. The Nifty also showed bullish candles. There were, of course, 3 bearish candles in the last week, but there were 2 bullish candles, smaller ones, and even though week-on-week basis it did make a gain, it definitely looked labored. I've added one more study in this week's weekly market outlook, and I'm going to discuss that chart with you. If you're even mildly statistically inclined, if you're using any kind of numbers as a system to play your game in the market on an intraday basis, you're going to find that very, very interesting. So let's jump right in. Friends, I'm Vijay Bhambwani, a trader with 35 years of experience, 28 years as a CEO, founder, promoter of a company that trades for a living. I'm making these videos to help you become better traders and to have discussions, meet like-minded people, connect on social media. My contact coordinates come at the end of this video, and we can get conversations going. So friends, coming up is the market roundup on your screen. We saw the Nifty rose more than the bank Nifty. We also saw bullion rising on a weak dollar. And the weak dollar is also partially the reason why the emerging markets, including Indian stock markets, rallied. Oil prices threaten to raise an inflationary fear. Now remember, on Wednesday, Thursday and Friday, there's been a geopolitical event where the Houthi rebels from across the border have attacked Saudi Arabia with drones, and on Thursday and Friday the Saudis have been saber rattling. They've managed to thwart a drone attack at their strategic airfield. The drone was intercepted, but the Houthis did manage on Wednesday to damage one airliner and result in some panic alarms being rung. Now this pushed up oil prices, and oil, as I have been telling you, is a multiplier commodity. If oil prices go up, fruits, vegetables, milk, egg, transport costs, etc., everything goes up. Now this is something, the geopolitical event will be something that the markets will be watching out for. The Americans have stepped in and warned the Houthi rebels to cease immediately, failing which they might intervene. So the geopolitical situation is a little tense, so that is something that we need to keep in mind when we trade next week. Also, we saw the 10-year benchmark bond yields cool off marginally because the RBI stepped in on Thursday in an open market operation, or an OMO, and bought approximately bonds worth 25,000 crores. They cooled off the interest rates. And the MWPL chart coming up on your screen, the market-wide position limits, which measures how much of open interest the traders have created in addition to last week. The open interest market-wide position limits show retail traders raise their stakes in the market, which is why the MWPL rose by 295 basis points on a week-on-week basis. Now look at the chart of the basis. The basis is the premium of the future versus the spot. Now on your screen is the basis chart of the Nifty and the bank Nifty, and both are showing contraction, which means they were selling at higher levels, and the premium in the futures is now compressed very significantly after the budget. This is particularly going to impact option buyers, especially the call option buyers, because you're going to see erosion in the option premium fairly rapidly if the market was to either consolidate or even decline marginally. Now coming up on your screen is the volumes a chart of stock and index futures. Now this shows that the traders are actually preferring to take exposure in stock futures rather than index futures. Index futures is where trader interest actually declined on a week-on-week basis. And now let's take a look at the impetus chart. Friends, impetus means momentum, means volatility, means the acceleration. Take a look at how this 20-day impetus chart is very interestingly showing that both the indices have peaked out on Tuesday last week. All right. So 9th of February was extremely critical because both the indices have shown a peaking out of their indices. And this is something every statistical trader needs to keep in mind. If you're doing any kind of trading models based trading techniques, you need to tweak your trading models immediately because the impetus is now easing off. By itself, it does not mean that the market needs to fall because of this. Because next week, the bulls might just return with force and pull the markets up. But let the impetus chart tell you rather than you second guess as to where you want the market to go. The market will go where it wants to go, not because you want it to go elsewhere. Now, let's take a look at the 10-year benchmark bond yields on your screen. The bond yields on a week-on-week basis fell marginally because the RBI stepped in on Thursday in an OMO, open market operation. Now, the reason why the RBI did this was to defend the 6% yield threshold. Remember, if the RBI was to keep borrowing costs low, interest rates low, it will be able to borrow next year, in the next financial year, starting from 1st April. The government, remember I spoke in my last video, needs to borrow 12 lakh crore rupees from the bond market starting from 1st April onwards. So the RBI is deliberately wanting to keep interest rates lower so the borrowing cost of the government can be brought down. Now, bonds stabilized, which is why the bank Nifty and many banking stocks also remained calm, in addition to the US dollar being weak. Now, don't let anybody tell you otherwise, but the dollar and the bond yields are directly interlinked with banking and bank Nifty, banking stocks and the bank Nifty. As a matter of fact, these factors also impact the Nifty futures. The bond yields done. Let's now take a look at the US dollar index, popularly known as the Dixie. Now, this US currency benchmark index against the global basket of currencies fell on a week-on-week basis, which is another reason why emerging markets, including India, rose last week. The index, as the chart shows, has fallen on 3 out of 5 trading sessions and ended 0.62% lower on a week-on-week basis. It also managed to close below its 25-day exponential moving average, and it will need to claw above this average to get into strong hands again. Last week, I advocated a range between 92.15 on the upside and 89.90 on the downside, which held perfectly well. Next week, I expect an expected range. I stress upon the word expected. Estimated range between 91.60 on the upside and 89.40 on the downside. And I feel the 91.5 level will be extremely critical to watch out for because it will be a strong barrier for the bulls to overcome. Unless the Dixie trades sustainably above the 91.5 levels, I think the bulls are likely to be under pressure. Friends, let's now go to the bank Nifty. As you can see on your chart, this managed to rally on a week-on-week basis on stable bond prices and weak dollar. But the intraday high of Friday, that is the 5th of February 2021, made in the spot segment at 36,615 levels still remains inviolate. The bulls have not been able to take the Bank Nifty above that level. Unless they do that, markets will appear to be tired, labored, and pausing for breath. On the flip side, a sustained trade below a previous swing low of 35,425 made on the 10th of February 2021 can trigger potentially more declines. And I hope you remember the impetus chart. Both the indices showed impetus peaking out on Tuesday, which is the 9th of Feb. And on the 10th of Feb, the Bank Nifty made a swing low. These are not mere coincidences. As statisticians, you would know about volatility clustering and beta clustering, which is what has happened last week, which is why I decided to add the impetus chart. Now, the week before last, this index was number 2 on the most volatile list, and it fell to number 4 last week, not because the volatility fell sharply, but because stock futures saw higher volatility. And last week I advocated an estimated range between 37,575 on the upside and 33,725 on the downside, which held beautifully. In the coming week, I expect an estimated range between 37,950 on the upside and 34,275 on the downside. So in case the market is weak, I think the support has a greater probability of being extended and violated as compared to the resistance being violated upwards in case the market rises, which means the bias is more towards the downside, slightly more towards the downside. Friends, the Bank Nifty done. I now proceed to take you to the most liquid low impact cost counter, which is the Nifty 50, the most liquid counter on the exchange. This index rallied 1.6% on a week-on-week basis, but do remember the impetus fell here also starting Tuesday, which is the 9th of February. In the week before last, this index was at number 6, but last week it fell to number 8 on the most volatile list. Here again, it's not because volatility has fallen on this index, but because individual stock futures volatility has gone up. Remember, I told you in the volumes chart that the volumes have focused more on stock futures rather than index futures. Now, this index is, as it appears on your daily chart on your screen, it's showing that the candles are getting progressively smaller, and which is what is confirmed by the impetus falling after Tuesday. This index fell on 3 out of 5 trading sessions, and do note the negative divergence between the price and the RSI, wherein the price is making higher highs, new highs, but the RSI is still not able to overcome its previous high. This phenomena is called negative divergence. I indicated this to you in the last 2 weeks, weekly videos, and this negative divergence still remains, which is another minor red flag as far as I'm concerned. Now, if the bulls were to overcome the peak made on Tuesday at 15,257 in the spot segment and keep the index trading sustainably above it, they are back in the saddle again. The weakness is gone. The markets can rally back. And on the flip side, if they were to take the market below 14,975, which is a swing low, it can trigger more selling. And the bulls will have to surrender a lot of their long positions, because not only does it break a psychological 15,000 round figure mark, but it also goes below its previous swing low. Last week, I advocated a range between 15,500 on the upside and 14,350 on the downside, which held perfectly. The coming week is likely to witness an estimated, I stress upon the word estimated, range between 15,700 on the upside and 14,600 on the downside. I still maintain my view that you should be trading light because there's overhang of uncertainty on the market from the geopolitical situation, from falling impetus, and you can also see that the basis has contracted. Now, as far as the Jensen's measure is concerned, now this is something I have been touching upon in the last 3 weekly videos. It's a measure of risk versus reward, whether you're taking one additional unit of risk is resulting in giving you at least 2 additional units of reward. The Jensen's measure paused last week, but now it is again showing hostility towards the bulls, which means if you do have to take long positions, at least avoid very large, big ticket long positions, especially in the leverage space where both your profits and losses tend to get amplified because you're leveraging your capital. Friends, I now come to the most popular segment of this video, wherein I give you 5 stocks which are high impetus, high volatility counters, where you take small exposure but bet on big price moves, and 5 stocks that are low impetus, low volatility counters, where you take large exposure, wait for small price moves. So the high beta list is led by SBI Life, number 2 being Motherson Sumi, number 3 MFSL, number 4 IDFC First Bank, and number 5 Muthoot Finance. Now, low beta, low impetus stocks where you take big exposure and wait for small price moves. Number 1 Hindustan Unilever, number 2 ICICI Bank, number 3 IndusInd Bank, number 4 Cummins India, number 5 LIC Housing Finance. Now, do remember that this hierarchy can change day to day because volatility can rise and contract on a day-to-day basis. So there might be an internal shuffling of these stocks. As a matter of fact, I do update a 20-day basic sort on volatility, volume gainers, market-wide position, limit gainers, open interest gainers and losers, etc. on my social media accounts. It would help if you connect with me on my social media account so you can see these updates late evening, Monday to Friday in real time and form your opinions accordingly. Friends, my contact coordinates are on your screen right now, and I would appreciate it if you would connect with me. We can get conversations going, discuss markets. And if you like this video, please subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive fresh alerts on videos being uploaded here. In the comments section, do keep the communication lines open. I'd love to hear from you. Tell me what you thought of this video, and if you like it, do feel free to share it with your family and friends and help me to reach out to other traders as well. I wish you a very, very profitable week ahead. Vijay Bhambwani signing off for now. Thank you for watching. Bye-bye.